Everybody to Big Changes, Big Opportunities, and what the new tax update means for your business. We are excited to welcome Tanya today to just break this down into English so we can understand it and know what to expect for our taxes that is coming up sooner than anyone wants to admit. Before we get started, I want to know, leave it in the chat. The chat can be found at the bottom right. Is if you were planning a holiday or if tax planning was a holiday tradition, which one would you most be like? Would you be joyful like decorating the tree or more stressful like untangling the lights? Drop it in the chat. The chat is where you can ask your questions. Be engaging. We'll ask Tanya throughout any questions that you have, anything you want her to elaborate on. Now's the perfect time to really grasp what these changes mean and how you can implement them for this coming tax season. And then these trainings are completely free, and we want to thank our sponsors for making that possible. And so we want to feature Stonebridge Insurance today. A special shout out to Stonebridge Insurance. They're known for providing trusted, comprehensive property and casualty coverage designed to protect both business and families. Their team takes a true relationship-focused approach, helping clients understand their risk and building coverage that fits real needs. So we're grateful for their support of today's webinar and for the work they do to keep Nebraska businesses protected and prepared. So thank you again, Stonebridge Insurance, for partnering with Grow Nebraska. We also want to give a shout out to our featured member. We're highlighting the longstanding member of Phelps County Development Corporation, or also known as PCDC. They have been a member with Grow Nebraska since 2013, and they play a huge role in supporting entrepreneurship, business expansion, and community growth within Phelps County. Their team is dedicated to helping local businesses succeed, from providing resources and incentives to fostering a thriving environment for both new and established businesses. We're grateful for their partnership and the impact they make here in Nebraska. So thank you again for helping us keep these webinars free. If you are interested in learning more about Grow Nebraska, please reach out. We love to assist businesses at any stage reach their goals. So whether you are just starting or you're well established but aren't sure how to navigate the next step in your business, we'd love to have a conversation and see if Grow Nebraska is a good fit for you, or if we can at least give you resources so that you can keep moving forward with your business ventures. So now, without further ado, I want to welcome Tanya to take the stage. I'll stop sharing, but we're excited to go over this topic.
That looked just like that. And I kept, when I saw this photo that you had, when I saw it, I was like, why is my hair doing that weird thing? Yeah, it's just gray. Hi everyone. Let me get this shared. All right. So I promise this is going to be kind of quick and a little painless for you. And then, sorry, give me 2 seconds to get organized so I can see the chat in case you have questions. By all means, like, ask as many questions as you want. Like this, like, I'll see them in the chat. If you want me to stop because you have a question, just raise your hand and then I'll just blather for a little bit about something super exciting while you guys type your question. The things that I wanted to talk about today are the changes. There was a new in 2017, under President Trump's first administration, a lot of the income tax law changed. And again, this year, a lot of it changed as well. Part of the parts that's changing for business, it's not like there's not so many changes for business, but there are some things that I just want to make you aware of so you can be mindful of them as you go into the 2025 tax return season, like filing your returns for 2025. So, it should be pretty quick and painless. I don't think we're going to need the whole hour today. So I am more than happy to spend the rest of the time answering any questions that you have. And just know that my default answer will be, it depends. And then you'll have to type more things in the chat. So, all right. So just a quick disclaimer. The purpose of this presentation is to enhance your knowledge on tax matters. It's not providing tax advice to any particular taxpayer, and it does not take into account any taxpayer's particular facts and circumstances. These slides are for education purposes only and should not be relied on for tax, accounting, or other professional advice. So what we're going to talk about today is QBI deductions, which stands for qualified business income, depreciation changes, SALT workarounds. SALT stands for state and local tax, child tax credits, the 1099 rules, and the tip and overtime deductions. So, all right, the first thing we're going to talk about is QBI. So the qualified business income reduction, it was originally passed in 2017 and it's been in effect ever since. So if this is not the first year of your business, you've already seen the QBI happen for you. It allowed for 20% reduction for qualified business income from pass-through entities, which are sole proprietors, partnerships, and S corps. It was made permanent under the OBBBA that passed this year. So the QBI previously in 2017 was going to phase out at the end of 2025. It was in effect from 2017 to 2025, and then it was going to stop after 2025. Now it is a permanent part of tax law until, I don't know, until Congress decides to make some other change. But currently it's in effect. What the QBI does is the rate increase from 20% to 23% for many taxpayers. There's phase out limits or index. Single head of household is 197,000 to 247,000. Married filing jointly 394 to 494. And if you qualified before, you still qualify now. And if you didn't qualify, you might now. So basically what it did, I like to read the slide and then we'll talk about it. So QBI, it basically says if you have $100,000 of taxable income from your business and you are one of these three business types, a sole proprietor, a partnership, or an S corp, it means that your business income is reduced from $100,000 to $20,000. And now it would be further reduced to 23% of the $100,000, which I can't do math in my head. Hold on, 3 and 20, $77,000. So now instead of paying business income tax on $100,000 like we would have in 2016, we would pay income tax on $77,000. Does everyone follow me on that part? So it takes our business income and reduces it by 23% if we qualify. If you qualified before, you're still going to qualify now. So let's talk about phase outs. Phase outs are this thing, like think of it as if you're a single head household and your income is $197,000. So everybody, as long as you're not driving, watch my hands. So you're at the bottom, $197,000, and you're allowed a 23% deduction, which is at the top. So as your income goes up, the amount of the deduction goes down, right? Until it passes and then it phases out entirely. So if you're a single person, like I'm single, so my S corp, if I have $100,000 of business income, I'm under the single threshold of $197,000, which means that I would get all 23% of the QBI deduction. However, let's say I go out and I go to Vegas with my girlfriends next weekend and I marry a super rich doctor in Vegas, like, Friday night, tomorrow night. So on December 12th, I get married. Turns out then if I'm married, then your filing status is determined on the last day of the year. So because I got married on December 12th and my super new husband or my super rich new husband makes a ton of money, my $100,000 of business income and his $500,000 of doctoring income would put us over the married filing jointly threshold, and then I would no longer qualify for the QBI. Okay, questions on the QBI? If you qualified before, you're going to qualify again, and it's a permanent part, and it got raised to 23% instead of 20%. Those are the biggest parts to know. So, questions?
I don't see any questions yet. If you guys have a question, drop it in the chat or raise your hand. I personally love the analogy though, so I
Right?
followed
Me,
right along.
rich doctor boyfriend that I'm going to go marry in Vegas. So,
Yes.
yes. So, all right. Depreciation in section 179. Thanks, Pam. So depreciation in section 179 Section 179 is literally the section number in the tax code. It allows for depreciating up to $2.5 million of qualifying property acquired after January 19th of 2025. Bonus depreciation on qualified production property, which we'll talk about in the next slide, and higher phase-out limit thresholds for purchases beyond $4 million, and you can fully deduct research and development expenses incurred during the fiscal year. So Section 179 is not new. It has been around forever. When I was in college and we were like studying Section 179, which feels like it was like 3.5 weeks ago, but it was like 20, yeah, it was easily 20 some years ago. So when we were discussing Section 179, the deduction amount was $179,000. That was the threshold. So if you bought $200,000 worth of assets in a year, you could immediately deduct $179,000 of them. If these assets under the first Trump administration, they changed the asset threshold to $2,500. And so if you bought something, if you bought $10,000 piece of equipment, you would still qualify for Section 179 deductions. However, Section 179 had to be only new assets. It couldn't be a new to you asset. So if you bought a used $10,000 piece of equipment, there was no bonus depreciation prior to the first Trump administration in 2017 when there was the Tax Cuts and Jobs Act was passed. The changes they made this year allow for new equipment, used equipment, and it's $2.5 million of equipment. So it used to be $1 million and now it's $2.5 million. But if you bought it before January 19th, then you're going to have to deal with the old rules. But if you bought it on the 19th or after, there's new rules. Okay. So bonus depreciation on qualified production property we'll talk about next. There are special deduction rules from now until 2028, the 2028 filing year, that increase the amount of depreciation you can have to $4 million. And then research and development expenses, these are super lucrative. So if you do any kind of research and development, and by any kind, like my clients that are breweries qualify for research and development because technically they're always developing new recipes and new flavors of beer, which covers the research and development credits. So these tax credits for research and development are amazing. A couple years ago, the IRS said, hey, wait a minute, if you're going to have research and development expenses, those have to be made assets and you're not allowed to deduct them. And so then all the tax credits were no longer lucrative. So what they did is they undid what essentially was a terrible choice by Congress and the IRS to undo the deduction. So now it goes back to how it used to be. And it's been that way for 30, 40 years. So, all right. So qualified production property. And I'm going to tell you this. The biggest thing here, it's previously, property was depreciated over 39 years. It temporarily allows for expensing if you meet these criteria. You have to use it as an integral part of a qualified production activity. It has to be in the US or a US territory. It has to be something that you're building. So the original use is with you, the taxpayer. The construction began again after January 19th of 2025 and before January 1st of 2029. And it has to be placed in service or the construction has to stop before January 1st of 2031. Leased property doesn't qualify and non-production portions of buildings don't qualify. So essentially what the administration was trying to do with the tax bill, in my like tinfoil hat, I don't know if we talked about it in college, but with my tinfoil hat, I feel like tax law has always been a way to regulate behavior. So this particular bill and this portion of this bill is designed to make it so that production comes back to the United States, and that they're trying to make it so that it is lucrative for people or companies to build production facilities in the United States. So what this is saying is previously, if you built a manufacturing building, like a plant or something, or even a small manufacturing line or a small building, you would have to deduct you would depreciate that building over 39 years. What this bill does is it speeds up that depreciation to now. So if you go out and like build a $500,000 facility or $1.5 million facility, you, as long as you qualify with this, it's in the US, you're a taxpayer, you built the building, you set it up to do the manufacturing, and you finish construction by 2031, then you get to deduct 100% of the cost of the building instead of doing 1/39th of it every year for the next 39 years. So what this does is it speeds up that depreciation. The non-production portions of the building, this part is, think of it as like if you built a manufacturing plant and you put an office on the second floor, that building of the office on the second floor doesn't count. So, all right, questions on depreciation. Basically, they made it easier to write off all the things that you want to buy or build. So, okay. So Belinda asked, Section 179 of the IRS code. Yes, it is Section 179. And should all chart of accounts include R&D? The majority of our clients are small businesses, looking for those analogies. So, possibly about the R&D. Not all businesses would qualify for the R&D tax credits. For example, you have to have a scientific method. And I have, Belinda, my email will be at the end of this. So you can send me an email and I'll send you like a quick little handout cheat sheet about the R&D tax credits. Everyone else is welcome to it as well. But so with the R&D credits, you have to have some kind of, like, you have to be solving some kind of scientific like measurement formula, something or another. You have to go through the whole scientific process that like we learned in biology class in the in the 8th grade. So you have to go through this whole methodology. And if there's some way to test what you're doing, then you would qualify. So usually it involves some kind of intellectual property, some kind of physical product. A lot of times, like, people don't think about it, but Grow Nebraska does a lot of things with people that are trying to make their products shelf stable, or they're trying to increase the production volume. And so all of those things, like as you're doing that recipe development, some of those activities would qualify for the R&D tax credits. So it's a very specialized type of accounting that I know just enough about to be dangerous, but I promise I can get you more information. So
Another question, in terms of building like production facilities, does it have to be new? Can it be like a remodeled building? And then, okay. And then
yes,
do like certified kitchens, do they fall into what would be considered a production facility?
interesting. I would, like, my gut tells me yes.
Okay.
So because they're still making stuff, you know. So yeah, I think there's a link to what industries, like, I think there's an industry link in this, and if not, I will look it up before I send you the slides. So I'm gonna write myself a note,
Perfect.
like, riveting tax seminar here. So, all right, salt. I love salty snacks. P.S. They're my favorite because I'm sweet enough. Anyways, so SALT stands for state and local taxes. SALT is currently capped at $10,000 per household, and it increases to $40,000 subject to phase outs. The bill restricts the workaround that pass-through entities use to bypass the SALT cap. And if you've been paying pass-through entity tax or PTATs, state tax deductions to offset federal income tax, your tax benefit might change. So what these words mean, under the Tax Cuts and Jobs Act in 2017, our mortgage interest, our property taxes, and our personal property taxes were capped at $10,000. So for those of us that live in Nebraska and Iowa, like, those $10,000 is okay, right? But my poor sister that lives in Santa Cruz, California, like, her property taxes are almost $30,000 a year, right? So my sister was only allowed to deduct $10,000 of her $30,000 of tax, property tax, right? this SALT portion, it includes property tax and state income tax as well. So clearly what I pay in income tax and property tax living in Nebraska is a lot different than what my sister pays living in California for property tax and income tax. So in 2017, when the first Tax Cuts and Jobs Act passed and capped it at $10,000, it negatively impacted my sister and didn't so much matter to me, right? So what happened is, like, pretend that I lived in California and this happened to me. What California and other states did is they said, hey, if you have a pass-through entity, and so remember that pass-through entities are these sole proprietors, partnerships, and S corps. So if my business was in California, what California did is it said, hey, your business can pay the income tax for you as an S corp owner. So instead of my business income starting in my S corp and flowing through to my personal tax return, and then me paying tax in California there, what happened is California changed their tax code and said now my S corp can pay the portion of income tax that I'm going to owe as an individual. And so what that did is that it would take if I owed, my business would be able to deduct my pass-through entity tax as a business expense, because income tax expense paid to a state was deductible at the business level, but not at a personal level, or is capped at a personal level. So hopefully that makes sense. That basically what the states did is they shifted who could pay the tax, and then it made it deductible again. Okay. So these PTATs are the pass-through entity tax. These pass-through entity taxes, like, because the limit is now changing to $40,000 instead of $10,000. So now, like, thank goodness for my sister, she can deduct all of her property tax again. But it also means that the benefit of paying the state income tax at the business level might not be as beneficial now that they raised the threshold to $40,000. So most of these pass-through entity tax don't apply to us in Nebraska either. But it is something that, like, I have an employee in Oregon, so I personally file an income tax return in Oregon. And last year I paid the pass-through entity tax to the state of Oregon from my S corp, and then I didn't pay income tax as an individual in Oregon. So this, if you did it before, it might change. So you should talk to your tax accountant or whoever's preparing your tax returns if you've done pass-through entity tax before. So, okay, questions? We're making excellent time. Like, we got to talk about like 4 more things, and then, it's just going to be a free-for-all hootenanny over here. So, all right. The employer provided childcare tax credit. This is another big thing. It increases from 25% to 40%, or 50% for eligible small businesses. The annual credit increased from $150,000 to $500,000 for employers and up to $600,000 for eligible small businesses. And it allowed pooling of resources with other businesses. The interest deduction also changed. So prior, the deduction was limited to the interest income, or 30% of the adjustable taxable income, or EBIT, which we'll talk about. And the current amount from December 31st, 2024 to January 1st of 2030, the adjustable taxable income now includes depreciation, amortization, and depletion, or EBITDA. So first, the child tax credit. I didn't put anything in about the eligible small businesses, but if any of you are more curious, let me know and I will 100% send you all the rules. But basically, if you are an employer and want to offer a child tax credit for your child care for your employees, then you used to get a credit for 25%. Now you can get a credit for 40%. The other thing is, all of us on this call could get together and form a daycare or provide childcare for our employees, and then we get to share the credits. That pooling of resources wasn't allowed before. And then we're allowed to deduct up to $500,000 of the cost for the childcare. So if we went out and all got together and figured out how to do childcare in somebody's facility, then we could deduct $500,000 of those expenses. We get a credit for $500,000. So the interest deduction. So previously, like if you had a bunch of interest, I heard a story about a guy that he borrowed some money to buy a failing arm of a International Harvester a long time ago, and he ended up writing. Anyways, long story, but he went out and he got turned down for 53 loans before he found a banker that said yes, and his first payment that was due was like $800,000, and it was all interest. Like there was some ridiculous like 18% interest or something like that. So for him, the prior deduction amount, like he could have only deducted 30% of his taxable income or adjusted taxable income. The EBIT stands for earnings before income, interest, and taxes. So what would happen is previously you could write off, you could always have depreciation and amortization on your tax return. But what this does is it changes it so that when you're figuring out how much you're allowed to deduct, you would now include depreciation and amortization, whereas you didn't before. So it makes it a little bit more generous for those people that had more interest than taxable income. So just know that exists, that these are there. And if you want to start providing childcare as a benefit to your employees, I would encourage you and, get in on it with your neighbors. So questions? We are so close, you guys. We only got 4 slides left. Okay. It is 1099 season. If you don't know what 1099s are, I would highly encourage you to call me and I will tell you all about it. So 1099 miscellaneous and 1099 NEC changes. The threshold for payments made in 2025 remains $600. The 1099 miscellaneous form reports rent payments, royalty payments, and proceeds paid to an attorney. The 1099 NEC form reports non-employee compensation. That's what the NEC stands for, non-employee compensation. The threshold for payments made in 2026 increases to $2,000. The 1099 threshold changes to over $20,000 and $600 in transactions. All income is still taxable and all expenses still need to be tracked. So I just want to make sure that everybody's clear about this. In the past, if you paid someone for services that was not a corporation, you have to issue them a 1099. You either issue them the miscellaneous form, if it's for rents, royalties, or an attorney, or you give them the non-employee compensation form, if it's anybody else. So like your accountants, your website people, your advertising agencies, your social media people, your repairman, your janitor, all of those things, right? Services to a business or non-employee compensation, unless they're a corporation. The rules change for payments made in 2026. So what forms we're going to file a month from now still have the $600 threshold on them. So you have to do the same thing that you've always done. And if you've never done them, again, call me and I'll help you. I'll tell you how to do them. And I'm not going to charge you for it. So like, I want you to, everyone should be like, I'm almost certain that everyone should file at least one 1099 every year. So I have one client that doesn't do it, and that's because he pays everybody with his credit card. So if you make payments with a credit card, they don't get put on a form. So just keep this in mind that new threshold happens for payments made in 2026. So the forms we file in January of 2027 for the 2026 tax year, there should be a lot less forms going out for that. Questions on the 1099s? Everyone busy running out and setting up childcare for their employees? Okay. All right. The tip deduction. I'm going to talk about the tips and the overtime changes because as employers, we're going to get asked a lot of questions. So The tip deduction are for workers on their individual income tax returns. The deduction is for up to 25,000 in qualified tip income. Phase out begins at 150,000 for single filers and 300,000 for married filing joint filers. Qualified tips, because remember it's only 25,000 of qualified tip income. Qualified tips are cash tips that are reported to the IRS either on a W-2 or 1099. The worker must be in an occupation that customarily and regularly receives tips. It has to be voluntarily paid by the customer, which means no service charges or mandatory tips, and it's valid only for the tax years of 2025 through 2028. The reason I wanted to bring this up is because a couple of things. First, it's only cash tips. So if any of you have tipped employees, usually, in my experience, when an employee receives a cash tip, they don't tell the employer, right? Employees will receive tips that are paid on a credit card, and those get reported on their paycheck and then get added to their paycheck. What is happening here? These cash tips, usually cash tips aren't reported to the IRS because the employee collects the cash and doesn't tell the employer. So not always, but that's kind of been my experience, is that usually cash tips don't get reported a lot. So just keep that in mind. If you own a restaurant and you are paying out credit card tips every pay period to your staff, those are not qualified tips for this tip deduction. Okay, it's only cash tips. So this is ones that are reported to the employer but not actually added to the paycheck. The overtime deduction is for qualified workers, and the premium, i.e. the halftime, you can deduct $12,500 for single filers and $25,000 for married filing joint filers. The phase out begins at $150,000 for single filers and $300,000 for joint filers. It's valid only for tax years 2025 through 2028, and all wages still must be reported. So both of these things, the phase out limits, remember, it's that same kind of thing. So once you reach $150,000, this deduction is no longer $12,500. It starts to become less until it fully phases out, right? And when I say all wages must still be reported, I mean you still put on the W-2 100% of everyone's gross pay. So you include the regular hour plus the time and plus the halftime portion. You include all of it on their W-2. Nothing has changed for that. The reason that I wanted to talk about both of these is because the IRS did not change the W-2. So when an employee sits down with TurboTax or H&R Block or whoever they're going to use to file their tax returns, and it asks this question, are you a tipped employee? It's going to start prompting them, and they're going to have to know where to go to find the information, right? So that's why I wanted to bring it up here. So what you should do if you're an employer. So you check if your business is on the customarily tip list, and I'll show you this list in a minute, and then report the cash tips that staff receive on the IRS forms, which means if your employees aren't telling you they're getting cash tips, if you start reporting their cash tips for them, then they would qualify for the tip credit. So, but basically what it's going to do is it's going to give them income and then take that income away. It's not actually going to impact how much they owe because they weren't telling you about it in the first place, so it wasn't reported. All tips are reportable as income, PS. So if you get a cash tip, if you're a tipped employee, all of it should be reported as income. And then track your voluntary versus non-voluntary tips. So no mandatory service charges, no gratuities, no credit card tips. And make sure that employees have access to their pay stub, their last pay stub in 2025, because that'll show them how much they made in cash tips, and it will show them how much they made in overtime. And then make sure that you're careful and report it correctly on their W-2.
So to go one step further, if a business hasn't been reporting cash tips, do you suggest just do so moving forward, or can you do a little catch up, if you will, from the year? What would be like the best practice for that?
So when tips are reported, the things that there's Medicare and Social Security that are deducted from the tips because they're included in gross pay and subject to FICA. And so there's Medicare and Social Security, but then it's also tax deducted from the employee and then taxed as an employer. So you want to be careful if you're reporting cash tips that haven't been reported all year, because the employee will end up in a negative FICA situation where they don't have enough net pay to pay all of the Medicare and Social Security on a year's worth of tips. And so then the employee would then have to pay that shortfall on their income tax return. So it gets messy super quick. So, but cash tips should have been reported all year. I would say like, and it's one of those things that like if an employee wasn't reporting their cash tips and want to start reporting their cash tips so they can deduct $25,000 of cash tips, like it's not going to change their income tax situation. It's just going to make them pay Medicare and Social Security on their tips. So does that kind of make sense?
Perfect. Thank you for elaborating on that.
Yeah. So it gets real weird. And I like when we first heard about this part, we're like, how in the world are we ever going to put this on a W-2? And then the IRS came out and said, we're not changing it. And then we're like, oh, thank goodness, because we're just like, what, we're halfway through the tax year. Like, there's no way that this is going to work. Like, how are we ever going to do it? But then we also realized that, like, nobody knows where this information lives. I mean, we do, but that's because we're nerdy like that. But like that's why I want to make sure that all of this information that your employees will need will be on their last paycheck stub, on their pay stub. So
Yeah, this is great information. If you guys have any clarifying questions or any other things that have popped up, remember you can drop it in the chat or raise that hand button as well.
this is the link as well. I can put it in the chat too. Maybe I can put it in the chat. So, and it'll be in the slides. But this is the list of qualified businesses. So it starts out with food and beverage services. Hold on. Let me make this a little bigger so it's not an eye chart. So it starts out with beverage and food services, and it lists most of those. Then it goes into hospitality and guest services. So bellhops, concierge, home services, and then personal services, and personal appearance and wellness. I'm going to get my hair cut on Monday. I'm super excited. Recreation and instruction. So tutors, transportation and delivery. So taxi drivers, Uber drivers, those kind of things. So this is the list. There's 13 industries that they list. So these are the ones that, so if you have workers that are tipped that are not on this list, they do not qualify for the tip credit. Okay. All right. Then one last thing. This is how you can get a hold of me. I'll put my email in the chat too. But if you have any questions, I'm more than happy to like answer whatever questions you have today. And then if anyone like, Belinda, if you want me to send you the R&D cheat sheet about what industries typically qualify for the R&D tax credit, just let me know and I'll happily send it over. So, yeah, just let me know what questions I can answer. We were talking about doing a different tax class, and which will cover everything that you never wanted to know about how all your business income will get taxed. So, but I'm happy to answer anything else, any questions you guys have.
Awesome. We'll wait just a few more minutes. If anyone has questions, please let us know. Thank you, Tanya, for going over this subject and making it digestible and even a little bit entertaining with your analogies.
Oh,
So
thanks.
loved
With,
it.
with my super fancy rich doctor husband that I
Yes.
haven't met
Everyone's
yet.
busy getting childcare set up. Um, and then I am going to share my screen quickly. Um, if you guys loved this webinar or want to see more like it, or if you have ideas, we want your feedback. Let us know what you thought of today's webinar. It's a painless, quick feedback survey. Just kind of lets us know what you thought, if you got out of it, what you expected, if you have ideas for other ones you want to see. We are looking at doing another session with Tanya. It's going to be a little bit different, and so be on the lookout for that announcement when we get it live. We will send a follow-up email for all of those who are registered. That includes the slide decks. We'll probably include a link and also Tanya's information. So if you have questions, reach out to her.
Yeah, and don't be bashful.
Yeah.
Yeah, because like of all the people here, I'm the one that went to school to learn this.
Yeah.
I
So
don't
no
mind.
question's a dumb question when it comes to this. That's
Exactly.
very inviting. And then we do have some upcoming trainings lined up. January, we kick off with Grow Through What You Go Through, which is going to be great. How you take that and project it into breakthroughs with your business. And then January 22nd, we're doing the Gemini Content Lab. And so a live marketing asset building workshop focused on AI and how you can make it work for you. We're excited to bring both of these speakers in for these workshops. So get signed up for those. We'll send you reminders. We'll send you the recording and bring questions to get them answered live. I do want to make a plug. Our Market Tech Conference is coming up. It's at the end of March, March 24th and 25th. We're really excited. We're going to be focusing a lot on AI and automations and just what that means for your business, how you can make it work for you, not against you. We'll have social media strategies, leadership, and marketing and website. So anything we think that your business needs to really propel itself forward. We do have an early access rate going on right now. It's going to be the best deal of the year, I say, but really of the market tech selling season. And so between now and December 31st, if you're interested, I would say sign up. You're going to save about $100 off on your ticket. If you're not sure, ask me more questions. I'd love to answer any questions about market tech and what to expect. Yes, Tanya.
Is it a day and a half like it was last year or this
It
year?
is. It's still a
Okay.
day and a half conference. Yes, great question. We did listen to our attendees, so we have adjusted some of the time frame. So we're going to start earlier the first day and end earlier the second day. And so the first day is going to be more jam-packed, and the second day we're going to get out earlier so everyone can make it home. So great question. It's a day and a half packed with you learn and you earn at Market Tech. So hopefully we'd love to see everyone there. If you're going to bring a group, reach out to me. We've got group pricing as well.
I had a great time last year, PS. I found out what I'm supposed to do with the social medias. Because
Yes.
like me as an accountant, I'm like, what am I supposed to do with social media? It's like take a picture of like, ooh, reconcile that. Look at these financial statements. Nobody wants to see that. So, but now I understand what I'm supposed to do with it. And I learned at marketing. So
I am so glad that you still remember that. That's great. I love it. Yeah, there's something for everybody, and there's great networking opportunity.
mhm,
And again, I wanted to make this training plug. So give us your feedback. You never know, we might show your topic next.
mhm.
And then thank you, everybody. I don't see any other questions that have came through. So thank you for joining us today. We are going to look forward to having you on our next webinar. Thanks again, Tanya, and have a great day and a wonderful holiday season, everybody.
Bye, everyone. Thank you.